You are looking at a chart that is lying to the impatient trader right now. Price is banging against 0.7161, the 5-hour and 1-hour are blasting strong buy, but the daily trend is a cold sell, and the dollar index is hovering near a 6-week high as Iran uncertainty and Fed rate hike bets freeze the market. There is one danger zone and one hidden opportunity today, and I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use immediately, whether you fade this or chase it. Here is your instant market verdict. The session bias for Australian dollar to US dollar right now is a bearish fade within a range, but with a trapdoor that opens below 0.7062. We are range-bound with a downward lean because the longer time frame moving averages and the dollar safe haven bid are acting like a ceiling, while the intraday bid is likely a stop run before the real move. The one invalidation level that flips everything is 0.7220. Write this number down. If we get a 4-hour close above 0.7220, the daily sell structure fractures, the dollar breakout narrative dies, and we shift to a trend-following long targeting the 0.7300 handle. If that level isn't touched, every rally is a short opportunity. Now let's walk the chart from the top time frames down to the 60-minute, because the institutional footprints are all over this. On the weekly, the trend is still a strong buy, and that's a critical backdrop. The 200-week moving average, which lines up neatly with the 200-day at 0.6790, is a long way down, so structurally the multi-month bull trend is not broken. This tells you that any sell move we see now is a correction against the primary uptrend, not a collapse into a bear market. The weekly MACD is still in positive territory, which is why I treat this downside as a pullback that could trap late shorts once the dollar bid fades, drop down to the daily, and the picture darkens. The daily trend is a confirmed sell, with price trading below the MA20 at 0.7189 and the MA10 at 0.7201. The MA20 itself is starting to curl lower, and the MA50 at 0.7039 is the next major magnet if this breaks down. The 100-day is at 0.7071, so there's a cluster of support between 0.7021 and 0.7071 that I expect to be defended hard. The MACD on the daily is just barely positive at 0.002, almost a flat line, which tells you momentum has evaporated. There is no conviction in either direction, and that's exactly the environment where fakeouts happen. The RSI is at 49.7, dead neutral. So the daily is screaming wait for it now to the 4-hour and 5-hour, where the strong buy label comes from. Here's what most traders miss. Those shorter time frame buy signals are generated by the MA crossovers and a slight MACD histogram tick up, but they're happening right below the daily resistance cluster. This is classic compression. Price is squeezing between the 5-hour MA at 0.7161 and the overhead MA10-MA20 resistance at 0.7201-0.7189. The 60-minute is also strong buy, but the candles are doing nothing. They're hovering, unable to break the very first resistance. When I see strong buy on the lower time frames but no price acceptance above the first resistance, I read it as exhaustion, not strength. Buyers are getting sucked in while sellers reload at the top of the range. That's the trap. The key numbers for today: immediate support is 0.7062, which is the floor of the last swing, and below that 0.7021, the multi-touch level that aligns with the MA50. Resistances are 0.7161, then 0.71890.7201, and then 0.7219. If 0.7161 is broken clean on a 1-hour close, the squeeze can run to 0.7200 before real selling pressure appears. But the daily chart says any push into that zone will be met with supply from the trend sellers. Let's weave in the cross-asset linkages before you decide your bias, because the Nikkei and US dollar to Japanese yen are acting as the risk validation pair, and gold is telling you something about fear that most equity traders are ignoring. Nikkei 225 is a mirror of risk sentiment for the yen complex, and it also drives capital flows into and out of the Asia-Pac region. If Nikkei is weak and US dollar to Japanese yen is bid because of yield differentials, that's a divergence. That would mean dollar strength is driven by safe haven buying, not just rate bets. And that safe haven buying is exactly what hurts the China proxy, Australian dollar to US dollar. I'm watching the Nikkei futures as I speak. If they fail to hold yesterday's low, Australian dollar to US dollar will have a very hard time breaking above 0.7189. Conversely, if Nikkei rallies, and US dollar to Japanese yen dips despite higher US yields, then risk sentiment is improving and that would give the intraday AUD bid some real credibility. For now, the Nikkei is shaky, which tells me the risk barometer is pointing lower for the Aussie, now gold and oil, the fear architect and the geopolitical heartbeat. Gold is bid on the Iran uncertainty, but interestingly it isn't blasting through all-time highs. It's moving in a measured way while real yields are rising on rate hike expectations. This tells me the gold bid is a temporary geopolitical fear premium, not a structural inflation trade. If gold was screaming higher alongside a falling dollar, I would read that as a risk-off signal that could eventually support the Aussie once the dollar turns. But right now gold's bid is coexisting with dollar strength. That is abnormal and suggests the market is pricing a short-term panic. For oil, the spike on Iran fears injects a stagflationary pulse into the global economy, which historically hasn't helped the Australian dollar because the RBA's commodity basket is more about iron ore and LNG. Higher oil pushes up import costs and can tighten financial conditions, adding headwinds for risk-sensitive currencies like the Aussie. So the oil spike doesn't rescue AUD, it reinforces the dollar bid through inflation uncertainty, and the S&P 500 Bitcoin divergence. The S&P is still hovering near records, but Bitcoin has shown a slight weakness relative to equities. That's a warning. Bitcoin often leads risk asset turns. If BTC or USD starts dropping while S&P just wobbles, it tells you that speculative excess is being wrung out. That environment punishes the Australian dollar because AUD is a high beta play on global risk appetite. So as long as Bitcoin lags the S&P, I need to be more cautious on long Australian dollar to US dollar trades. The fundamental fuse for the next 24 to 48 hours is wired directly to yesterday's news, the dollar hovering near a 6-week high because of Iran uncertainty and rate hike bets. The market has begun repricing the Fed's terminal rate a touch higher after hawkish comments and the persistent safe haven flows, and that's why the DXY is refusing to roll over. Today's story is market's weight as the US dollar strengthens, and that weighting is precisely why we have this compressed range in Australian dollar to US dollar. Traders don't want to commit before US PMI data and any fresh Iran headlines. I'm expecting the dollar to remain bid until something breaks, either a dovish Fed speaker later today or a de-escalation in the Middle East. The RBA meanwhile has been relatively quiet, and Chinese economic data hasn't provided a positive shock, so the China proxy remains without a catalyst. My 1 to 2 week directional lean. The path of least resistance is lower for Australian dollar to US dollar, towards 0.7021 and possibly 0.6950, as long as the dollar holds its bid and risk sentiment stays fragile. The event that would invalidate this bearish lean is a daily close above 0.7220, especially if it coincides with a breakdown in US dollar to Japanese yen and a Nikkei rally. That would tell me the dollar tide is turning and the Aussie is ready to lead risk higher. Until that day, I'm selling rallies. Most people will skip this next part, but this is where money is made. Keep watching. I'm going to hand you 3 executable trade setups for today's session: conservative, standard, and aggressive, with exact triggers, stops, targets, and the risk-reward logic behind each. No theory, just a plan. Strategy 1, the sniper, conservative. This setup waits for confirmation that the daily resistance is holding and the intraday strong buy is indeed a trap. The trigger, price must rally into the 0.7185 to 0.7200 zone and produce a clear 60-minute bearish rejection candle, an engulfing, a shooting star, or a long upper wick, while the 60-minute RSI stalls above 60 and rolls over. Entry is on the break of that rejection candle's low, typically around 0.7175. Stop loss goes at 0.7225, just above the daily resistance cluster and the invalidation level, giving you a 50 pip risk. The logic: If price gets above 0.7220 on a closing basis, the daily downtrend is compromised, and we must exit. Target 1 is 0.7110, the midpoint of the recent range, which yields a 1.3 to 1 reward. Target 2 is 0.7062, the major support, giving a 2.2 to 1 risk reward. This setup is voided if price never reaches the sell zone and instead breaks below 0.7130 with momentum before you get an entry, because then you've missed the top and chasing would hurt. The risk reward strategy 2, the active trader, standard, for those who want to participate without waiting for the perfect fade. Entry condition, a pullback and rejection at the 5-hour moving average, which is currently at 0.7161, or, if price is already below it, a retest of that level that fails. I want to see a 15-minute close below 0.7155 after a poke higher, with the 15-minute MACD histogram flipping negative. Enter short at 0.7155. Stop loss is placed at 0.7195, just above the MA20 and the psychological 0.7200 handle, keeping your risk at 40 pips. Target 1 is 0.7110, again, for a 1-to-1 plus, but we use a rule. Once target 1 is hit, immediately trail the stop to break even on the remaining position. Target 2 is 0.7080, which is a support pivot from earlier in the week. If the selling accelerates, you can ride the second half to 0.7062 with a trailing stop of 20 pips. The invalidation is the same. An hourly close above 0.7200 voids the setup. Let's see how aligned we are. Type your Australian dollar to US dollar high and low range for the next 24 hours in the comments right now. I read them during the session and I'll pin the most accurate one tomorrow. This helps everyone see the market's collective expectation. Strategy 3, the aggressor, high risk. This is for those who want to trade the intraday strong buy signal against the daily trend, knowing that the herd is short and a squeeze can rip. Entry is a market buy at the current price of 0.7156, with a very tight stop at 0.7130, just below the recent low and the 60-minute support pivot. That's a 26 pip risk. Target 1 is the MA20 at 0.7189, where you must take partial profits and move the stop to entry. Target 2 is 0.7210, just under the 0.7219 resistance, giving you a 54 pip reward for roughly a 2-to-1 risk reward. The warning: this is a counter-trend trade against the dollar strength and the daily sell signal. Only take it if you know how to lose small and if you see the Nikkei futures turning green and US dollar to Japanese yen dipping. If price breaks below 0.7130, get out immediately and do not look back. This trade relies entirely on a sudden risk-on wave that may not materialize. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact news events like US PMIs or unexpected Iran headlines. Stops are non-negotiable. If you can't honor a stop, you are not trading, you're gambling. So here's the one level that matters most for the next session: 0.7161. If that level holds as resistance going into the US Open, the trap is set and we visit 0.7110 and likely 0.7062. If it breaks with volume, the daily bears must wait, and we could see a panic short cover rally to 0.7219. That's the chess move. Tomorrow I'm turning the lens on the US dollar index and S&P 500 liquidity tide, because the PMI data and Fed speak could crack the dollar's 6-week high wide open, and that will change the altitude for every dollar pair. And if you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen and go straight there, because the correlation is breaking down and that always signals a big move in risk assets. Smash the like button if this analysis gave you a clear plan. Subscribe and ring the bell for daily institutional grade coverage. I'm here every session, same time, 8 assets, no noise. I'll see you in the next one.